Aloha, I'm Stan Cox, Principal Broker and Strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy. Today we're going to talk about finance myths that are holding you back from achieving your goals. Banks are the best and safest place to hold your money. You can count on qualified retirement plans to fund your entire retirement. Buy term and invest the difference. Always pay cash. You can't have your cake and eat it too. Well, we'll start with these, and you will see that there are a number of others that are connected with these myths. Let me say this. If banks were the safest and best place to stash your cash, why do they need Federal Deposit Insurance, FDIC? Yes, it's nice that they do have your money insured when you deposit it with the banks, but it only covers up to $250,000. So what if you have $300,000 or more in the bank and the bank fails? And they do fail. Remember the bank bailout of 2008 following the subprime mortgage bubble bursting? That isn't the first time the government had to bail U.S. banks out. It's just a matter of history repeating itself. Since 1791, yeah, like well over 200 years, governments had to bail out banks because they fail. So here's another point to consider. Banks are legally permitted to loan 10 times the amount of cash they actually possess. And there's a name for that. It's called fractional reserve banking. Most people aren't aware of this legal Ponzi scheme, but you can look it up. It's real. I might add, it's real scary. So if the banks are not the best or safest place to stash your cash, what is? Hang in here for a couple of minutes and I will tell you. The next two myths kind of go together. The myth is you can count on qualified retirement plans to fund your entire retirement. And it's better to buy term and invest the difference. Here's the problem with those myths. First, qualified plans allow you to invest pre-tax dollars and defer the income tax. But make no mistake, you aren't getting away with not paying the income tax on the money you invest in those plans. On the contrary, you're not only deferring the tax, you will have to pay income tax on the money you invest, and if you succeed on making gains on your investment, you'll also have to pay tax on those gains as well. And you'll have to pay that income tax when you take the money out of the plan, presumably when you are retired and don't have that full paycheck that you collected during your working years. Not only that, it is most likely that the income tax rate will be higher for you when you eventually retire. Why? Well, because income tax is at the lowest it's been in decades. And the federal deficit is higher than it has ever been, by far. So, income tax rates are bound to increase. That means that it's likely that even if you are in a lower tax bracket in retirement, you will most likely have to pay a higher amount than you are right now. The other main objection to qualified plans is that the money is invested. That means your money is at risk of loss. There are no guarantees with investments that your money will generate gains. The only guarantees with qualified plans are, one, you will have fees deducted from your account every year. And two, your money is at risk of loss. So, to put all your eggs, so to speak, in one qualified basket plan is a large leap of faith, and you could end up paying dearly by losing a good deal, if not all, of your retirement savings. So what's a better solution? I'm about to get to that. Hang in there. Now, let's consider the buy term and invest the difference myth. This is the mantra of many, if not most, financial planners and advisors. What it is saying is you should buy a term life policy and invest the difference in cost between the term premium and what a whole life insurance premium would be for the same amount of insurance. Yes, when you're younger, term insurance is a good deal less than whole life for the same amount of insurance. But here's the big problem with that myth. Term insurance will terminate in 10, 20, or 30 years without generating any cash value. So when it does terminate, you will have nothing to show for all the premiums that you paid into it for all those years. And then you'll be 10, 20, or 30 years older. And who knows what your health will be like in your older years. So if you want to renew the policy or get a different one, the premium will be much higher. Age and health are the two biggest factors in price of the premium. Another problem with that myth is that the invest the difference part. We already discussed that. When you invest, your money is at risk of loss. Really, the only ones who benefit most from that myth are the financial planners and advisors who collect those money management fees from your account every year. Why do you think they advise that myth? Always pay cash. Now, this one is probably the hardest to argue against. The main problem with this is that it costs to pay cash. Yes, it costs if you finance in any traditional way as well. Loans and credit carry costs such as interest and fees. But paying cash also carries opportunity cost. And that means that it costs you the interest you could earn if you put the money into an interest-bearing account instead of paying cash for what you buy. Of course, you have to pay for things. So what's better than paying cash? Is there anything better? And that brings us to the myth, you can't have your cake and eat it too. Because you can. And this solution is the answer to all the myths we've discussed here. You see, a properly designed, participating whole life insurance policy is actually the best and safest place to stash your cash. Now hold on, don't jump now. Let me explain. I didn't say just any whole life policy. I'm talking about a properly designed, participating whole life policy. Now, participating policies are issued by mutual companies and pay dividends to those participating policies on top of guaranteed interest, which is much higher than any banks are offering. When such a policy is properly designed, the actual cost of the premium goes down and it has cash value right away that grows with a minimum guaranteed rate plus dividends. And you can leverage the cash value to buy things, pay for things, and without paying the opportunity cost. So yeah, you can have your cake and eat it too. That is also why the buy term and invest the difference myth is so damaging to your financial goals. Again, no cash value builds in a term policy, and the cost of insurance continually increases. Then it terminates and you have nothing. And again, investments put your money at risk of loss. So what would happen if you buy a term policy and invest the rest of your money that you are allocating for future income, and the market crashes and you lose your investment? What are you left with? Nothing but a heartache. What then is a better solution? First, protect your income, your source of income, you. Buy a properly designed, participating whole life policy that builds cash value and that you can use for emergencies and to leverage for financing things. And then work on building your investment portfolio within your actual risk tolerance. And that means investing only as much as you can afford to lose in the case of a downturn in the market. So let me ask you, if every time you deposited $1,000 into your savings, your account kicked in an extra $62, tax-free, how would you like that? Then, whenever you want to, you can leverage that $1,062 to pay for things, and it would continue to earn more tax-free interest for you with no risk. That's exactly what we're talking about here. That's how a properly designed participating whole life insurance policy works. It provides a safe place to grow your money, guaranteed, in a way that you can actually use the money while it continues to grow. Let me say that again. You put your money into this savings vehicle, the account adds tax-free dividend interest, compounding. You use the money to pay for things, and the money continues to grow in your account as though you never touched it. You have questions at this point, no doubt. All your questions will be answered for you when you watch our free webinar, How to Become Master of Your Financial World. And that's you just click the link below in the description box here. Check it out and let us know how we can help. Please subscribe to this channel and post your questions and comments here. And mahalo for watching.